My name is Michael Guyette, publisher of the Lead Lang Report. Joining me for the hour is Greg Daco, who has got some interesting thoughts when it comes to inflation. Been looking at his feed. I think no one better to talk about some of the news today and maybe market reaction. But Greg, introduce yourself to the audience. Who are you? What's your background? How'd you get involved, interested in economics and markets, and what are you doing currently?
So I currently am chief economist at EY. I lead the economic research team at EY. We produce original insights on the macroeconomy, and I spend a lot of time having discussions with business executives around the macroeconomic outlook, how that influences their business decisions. We know that we've been in a multi-speed global economy over the last few months, and there are a lot of questions as to how that particular and unique business cycle is influencing business decisions. Prior to joining EY, I was chief economist at Oxford Economics. It's a macro consulting company. And prior to that, worked at IHS, or the company that was acquired by IHS, which was Global Insights back in the days.
I want you to further tease out that point about a multi-speed economy, because I'm going to argue that it's not just a multi-speed economy, it's a multi-speed market. I mean, you've got large cap tech in particular looking very different than small caps, looking very different than the typical average stock. Has there ever been a time in history where seemingly there were so many disconnects, where it's not like it's everything moving in a monolithic type of way?
Yeah, I think we had been accustomed to an environment where things were generally moving in the same direction when it came to the global economies around the world and even different sectors. And that period that preceded the COVID pandemic, the 10 years between the financial crisis and the pandemic, were an environment where we generally saw this fairly homogeneous movement across sectors and across economies around the world. And then we had this sudden stop to both demand and supply from the pandemic, from the COVID crisis. And in the wake of that, because we had this significant mismatch between supply and demand, we've had unprecedented inflationary pressures, which led central banks around the world to tighten very aggressively and countries to reopen at their own speed. And so we're left with this environment where you're correct, it's not just a multi-speed global economy in the sense that some economies are accelerating, some are decelerating, some are stagnating, but it's really that within each of these economies and across sectors, you're seeing an environment that some have described as this rolling recession environment, where some sectors are experiencing recession one after the other, and others are doing relatively well. We've also been hearing about the poly-crisis type of environment where you're seeing crises across different segments. I prefer the multi-speed analogy because it's really not just about downside risks. I think there are some significant opportunities here in this type of environment.
Multi-speed also sounds confusing, right? So talk about from kind of an econometric modeling perspective. How do you guys think through the fact that everything's moving at these different rates of change?
Yeah, I mean, it's an environment in which you're not necessarily, everything is not moving in the same direction. And you could look at inflation, for instance. We had been in an environment where essentially most of the world, both advanced economies and emerging markets, were experiencing an environment of accelerating inflation. So prices were rising, but they were rising at a faster and faster pace. And so there was this fear of prices spiraling out of control. And once we essentially got past that initial wave of inflation across the world, we started to see central banks tighten monetary policy and in most cases tighten very aggressively. And now we're in this very different environment where it's not just about inflationary dynamics and inflation accelerating, but it's the fact that in most economies around the world, we're past peak inflation. But in some economies, we're seeing more stickiness, more persistence in inflation. So prices are still rising at a fairly rapid clip in a lot of economies around the world. In other places and in other sectors, you're seeing prices rise, but at a slower pace. You can think of the goods segment, for instance, as a good indicator of that. And then you have other sectors that are seeing price dynamics actually move in the other direction. You're seeing so-called deflation, where prices are falling. And that makes it very difficult to navigate this type of environment and to forecast. It's not just about looking back at what has happened over the past few months, but really anticipate what's likely to come ahead for economies around the world, for different sectors, but perhaps more importantly, for business leaders. As they try to navigate this environment, both business leaders and investors, they want to have some sense of understanding as to the appropriate direction of the economy. And in this highly volatile and highly ununified or heterogeneous environment, it's very difficult to do such forecasts.
What do you think it would take for things to kind of sync up more properly to history? Is it just as simple as get back to some kind of 2% inflation rate, or do you almost need to have, for lack of a better way of saying it, it's kind of an event, because in high volatility everything tends to kind of correlate the same way?
Yeah, well, I think there would need to be some sense of stabilization when it comes to monetary policy in particular. So we've seen that central banks are laser focused on getting inflation back down towards their targets, and their targets are divergent, and inflation dynamics are very different across different places around the world. Once we are back in an environment where inflationary dynamics are actually no longer a subject of conversation, when inflation takes back its secondary role as it was pre-pandemic, then central banks will have the flexibility and the leisure to ease up and recalibrate their policy stance to the downside. And we will likely be in an environment where there is less divergence in terms of the credit impulse, in terms of the economic impulse. I think if you think about it, more broadly, we're still going to be riding the waves, the post-pandemic waves, in a sense, the ripple waves from this massive shock. I think we tend to underestimate how significant this shock was to the system. It was a warlike type of shock where everybody, shut down essentially, from the consumer to the producer to the investors. Everybody essentially shut down for a couple of months, and then things started to reopen. The problem is that you don't restart a global economy as easily as you shut it down with this pandemic. And so the ripples and the waves are likely to remain in place for some time. And I wouldn't be surprised that we see more volatility, in a sense, in economic data going forward than we had been seeing in this period that was dubbed the Great Moderation over the last 30, 40 years.
So I shared at the top of the Twitter space in the Nest a very well formed tweet around the breakdown on CPI, and you put a hashtag culprits around used cars. I saw it, on the periphery, and I've been on calls all day long here today. But break down for the audience that tweet, and other than used cars, and we'll get into used cars in a bit here, but other than used cars, were there any other surprises or things that you think people should focus on?
Well, yeah, I mean, when I was looking at the CPI report, the first reaction was, well, this is a fairly hot and sticky reading in terms of CPI. You had both headline and core rising 0.4 on the month, and just as a side note, increasingly what will matter is the sequential momentum, not so much the year-over-year pace of inflation, which will be declining because of base effects and because we're also riding a strong wave of lower energy prices. But the point I was making in the tweet is that if you look at the composition of the increase in prices in April, it's actually quite reassuring, because the used car prices component surged 4.4%, and the contribution of that alone to the headline print and the core print was around a tenth. And if you look at the core commodities indicator, sub-indicator, that rose 0.6%, which was the strongest rise in more than a year. All of that came from used car prices. All the other indicators are showing less significant increases, or in some cases, decreases. New car prices are still decreasing. Apparel prices are rising at a slower pace. food prices have been flat in the last couple of months. This is the first time since before the pandemic that we've seen that. And then service prices, the service sector that the Fed is so focused on, the core service sector, which is essentially services excluding shelter and energy, those posted the slowest gain in a year. So we're looking at dynamics that are disinflationary, quite strongly so. And even the housing sector, shelter costs, when you look at rent prices and at owner's equivalent rent, which are two of the key subcomponents in the shelter costs, those are also showing signs that they're rising, but at a slower pace. So that's the type of dynamic that you really want to be seeing when it comes to the inflation outlook, so moderating inflation, but also when it comes to monetary policy, because we've seen the Fed maintain a very, if not extremely or excessively data dependent approach. And these types of readings point to moderating inflation, which, if anything, will likely keep the Fed on pause at this stage. And if we continue to see these types of readings, will likely lead it to consider going forward the possibility of recalibrating policy to the downside. Maybe not this year, but early next year.
Yeah, I like that way you framed it around bumpy disinflation. But you and I both know that interest rates act with a lag, and I made that point earlier today in a tweet. CPI today is based on interest rates from many months ago. Who knows exactly how many months ago, right? Because it's not always a consistent type of thing. But do you get a sense that is there anything in your work that would suggest the Fed maybe has already over tightened in the sense that, okay, you've got strong disinflation starting or really kind of accelerating, but you haven't yet had the full impact of the prior rate rises?
I think certainly I've been advocating for less of a backward looking approach when it comes to policy making. I think there's been a lack of firm anchors when it comes to policymaking at the Fed. Fed, we know, was caught, somewhat off guard in terms of its policy when it came to the persistence of inflationary dynamics, and it reacted by going very aggressive in terms of its tightening cycle. This was the fastest tightening cycle that we had seen since the Paul Volcker era back in the late 1980s. So a very rapid and aggressive tightening stance. But as you say, there is a lot of uncertainty as to the effects of this tightening of monetary policy on economic aggregates. If we're just focused on the backward looking data, on April inflation data, which likely reflects February to March spending impetus, then that is essentially going to lead us into the wrong types of decisions when it comes to the ideal, the optimal monetary policy environment. So I've been advocating for a pause. I think that at this stage, monetary policy is tight enough. Inflationary dynamics are indicating that there is a significant cool down underway, that this process is not just about to end, that it will continue, and may actually, this is my view, actually surprise on the downside, that we may actually end up in a more rapid disinflationary environment than is currently anticipated by the consensus. I fear there's a little bit of a recency bias whereby people anticipate that the inflation stickiness that we've seen over the past 18 months is likely to persist. But if anything, just to come back to the most recent data we have, if anything, it shows that whether it's hotel prices, airfare, or just in broad terms, the leisure and hospitality sector, those are starting to see some turnarounds in the prices on a month to month basis. Why? Because demand is cooling. Even though there are people that still have the means to spend, and even though there is still that narrative of people enjoying the services that they couldn't enjoy during COVID, that narrative, I think, is increasingly going to be misguided when you look forward, because prices are very high and price levels in the end are what matter for the average Joe, not inflation, which matters for me and for you and for those that have a little bit more insights into what inflation is.
Well, and I think the market expectations seem to agree with your view on that. There does seem to be a pretty remarkable difference in belief, right? The Fed doesn't is seemingly does is saying, well, we may not be done, and we're not planning on lowering rates at any point this year. While I think Fed futures are expecting three
Mm-hmm.
cuts, right? And I
Yeah,
think they put a
roughly. Yeah.
tweet about that. Has there ever been anything that you've looked at where you've seen that much disagreement between what the Fed is saying and what the market's pricing on?
Not in recent history, to be honest. I mean, there certainly have been periods of significant disconnect between market pricing and Fed, what the Fed message or the Fed communication is. But this is proving to be quite persistent. And you're absolutely right to highlight the fact that the Fed has been hammering this message that there will not be rate cuts in 2023. And markets have continued to price rate cuts, about 75 basis points worth of rate cuts over the course of the back half of this year, with the first rate cut coming in September. So that's pretty close to where we currently are. There are a couple of notable things to highlight when it comes to this disconnect, because it goes back to this lack of a proper anchor for the Fed in terms of monetary policy. In the past, the Fed was able to essentially disregard to some extent its price stability mandate, right? Focus on the employment mandate and focus on financial stability, which is the often forgotten third leg of its mandate. And we saw that in the wake of this very long expansion, this very long business cycle that lasted from the end of the financial crisis to the pandemic, essentially the Fed realized that it had been too focused still on the inflation element of the mandate and not allowing the economy to really run hot, to reach a higher level of broad-based employment. And so it changed its framework to adapt to this rear view mirror of the economy that had a lot more potential and could have had more potential had it not tightened as much as it did from 2015 to 2019. Now, that framework is not well suited at all for the post-pandemic era, where we've had this inflationary environment and where that inflationary environment has been quite sticky. Now we come to this big question for the Fed, which is, what does it want to anchor its policy framework on? And how does it want to communicate its intent to lead monetary policy coming out of this period of very strong and persistent inflation? And that's where the credibility issue comes into play. At one point, the disconnect between what the markets are anticipating and what the Fed is saying will have to be reconciled. And one of two things will happen. Either there will be a market repricing and therefore much more volatility coming forth in terms of expectations for the Fed to not cut rates, or the Fed will succumb to market expectations, and by cutting rates in 2023, it will essentially lose a lot of credibility in terms of its own anchoring of monetary policy. I'm fearful that extreme data dependence in this very volatile environment that we've been describing is a very risky proposition for the Fed, and something that it will need to address very rapidly, because, as I was saying, it cannot no longer just focus on the financial stability aspect of things, but it has to focus on its triple mandate of ensuring inflation comes back down towards its target, so price stability, ensuring that it moves towards an environment that is still robust on the employment front, and ensuring that there is financial stability. That is a very difficult mission for the Fed in the current environment.
Speaking of financial stability, I think that's a good transition around the debt ceiling. I did a Twitter space with Jeffrey Hirsch of Stock Traders Almanac yesterday, and he had noticed, and I've been seeing this on Periphery, but it's actually pretty remarkable. If you look at the credit default swaps on the U.S., right, you're reaching like 2008, 2009 levels. It's actually past the 2011 debacle back then and summer crash because of the debt downgrade. Is that just some institution that's trying to play a black swan type of insurance bet, or is there some validity to maybe this time it's a little bit different the way the rhetoric is playing out?
I'm concerned, to be honest. I'm concerned about the way things have been evolving. There were really four potential scenarios that could have unfolded when it comes to the debt ceiling debacle. Number one was a clean increase in the debt ceiling that has happened in the past. Unfortunately, given the landscape in DC, that's not going to be the case. The second option is what I still think and secretly hope is most likely is essentially this negotiated outcome whereby Congress gets together and essentially says, we will most likely suspend, I would think, the debt ceiling and tie to that some form of agreement to reduce spending in the next budget. I wouldn't be surprised that the outcome ends up being pushing back the deadline to, let's call it September or end of the summer, and essentially tying that to an obligation to cut essentially spending. Very similar to the type of super committee outcome that we had back in 2011, which led to this so-called Budget Control Act, which essentially capped spending, both on the defense and non-defense front, by the way. So that's the second option. The third option, which is increasingly, likely, is essentially some form of executive action. So we've talked a lot about the president's ability to invoke the 14th Amendment of the Constitution and saying that the validity of the debt shall not be questioned, in a sense, authorizing Treasury to pay its prior debts. And then the fourth option is essentially a default. And that's the catastrophic one, right? That's the one where you end up in a situation that not only leads to a significant economic downturn, because you would have to cut government outlays to be equal to government revenues, which means cutting about 4.5% of GDP. But you will also have, as you were just highlighting, a tremendous amount of financial market stress. Volatility surging, stock prices falling, private sector confidence dropping, the dollar collapsing, and potentially some further stress on the Treasury market front. So that type of situation is really what everyone should aim to avoid, because that is the most catastrophic type of outcome. But the other two that are still likely, the negotiated outcome and the executive action, those are not without pain, and they will also likely be quite problematic, both in the short run, but also potentially in the long run.
I will say that's one way to quickly get to 2% inflation is if you were to have an actual default. Like going back to, if you're going to go back to a long run average of 2%, you need a period of deflation. Mm-hmm. And you get any kind of credit event that would do it. Now, that will be a hell of a credit event, even if it's, sort of a mini default in terms of extending out or however they do it, right? Technical default, so to speak. And that would be enough to shake confidence in all credit issues.
I mean, to your point, this type of shock to the system would not just get inflation back down to 2%, but could lead to a severe deflationary environment. Because, just to give people a sense of context here in terms of what this means on the economic front, when you cut spending to be equal to revenues, federal spending to be equal to federal revenues, you're cutting the amount of the federal budget deficit, which is currently around 4 to 4.5% of GDP. That's in nominal terms. If you adjust for prices, you're looking at 3.5 to 4% in terms of the real GDP shock. Now, how does that compare in terms of prior recessions? Well, take a look at the financial crisis back in 08, 09. The shock was about 3.5% of real GDP. The peak to trough decline during the COVID crisis was about 10%. So that gives you an order of magnitude of how severe the hit to the economy would be. And as I mentioned, it's not just about the economics of it, it's also the financial market ramifications. So if you have a significant tightening of financial conditions and potentially global financial ramifications, global financial conditions tightening as well, then the combination of all those factors would likely lead to an even greater hit in terms of economic activity. And there's no real process through which you could really prioritize payments. There is a different system of payments for interests on the debt, and I think Treasury would like to promote that and ensure that interest payments on the debt are guaranteed. But other payments are by no means guaranteed. So do you go chronologically? Do you try to sort out through the millions of payments that go out on a daily basis? How do you proceed in doing that? And how do you avoid a shock to the most sensitive parts of our economy via Medicaid payments, delays, Medicare, Social Security, veterans payments, and all those types of payments that populations depend on across the US. So if you have that type of shock, it's not just a disinflationary effect, it's a deflationary shock that occurs under that type of environment. And this is all tied into the Fed, right? It's no surprise that there were questions for Jay Powell at the last press conference around how the Fed would act in this type of environment. There is the possibility of the Fed buying treasuries to essentially ensure that we don't end up in an unfortunate financial situation, but that's not guaranteed. And again and again, the message comes back that Congress needs to act. The debt ceiling is not something that should be played with. It's not useful, and the debt ceiling in and of itself, should probably eliminate it altogether. But we have it today, and we have to deal with it today.
As you were talking, I was just going to Chat GPT to see what it thought about prioritizing payments, and the response I got was, "Well, we're all fucked." So I don't think that's going to be possible.
All this stress that we're seeing in the economy, in terms of the policy situation, and in terms of the banking sector stress that we've seen over the past few weeks, couple of months, is all interrelated. And so we have to be conscious of the fact that a shock to the system at this stage in the business cycle could be quite problematic. There's still uncertainty as to whether the economy will go through or live through an outright recession. I think the odds favor recession, but there's still some uncertainty as to that outcome. But all of this stress that is being added to the system, including what I've called the unknown unknowns, increases the odds that we end up in a significant contractionary type of environment. The unknown unknowns are what I'm most fearful of, and you can't describe it, you don't know what they are. But if we look back at the last 6 months, we look at what happened with pension funds that were having to make margin calls, and the stress that was present in the UK economy when the Truss administration released an unbelievable budget and led to significant stress in the pension fund system, and forced the Bank of England to intervene and do a major U-turn when it came to buying gilts. That shock, or the collapse of SVB and other institutions in the last few weeks that were really not foreseen up until the very day they occurred, those types of developments indicate how there are fragilities in a system where the private sector has yet to fully adapt to the very high likelihood that we're likely to stay in an environment where the cost of capital will remain much higher than it was pre-pandemic. Doesn't mean it might not fall slightly over the coming months, but it means it will be higher and remain higher than it was pre-pandemic. And that adjustment means that it's going to take more time before we have less volatility. To your earlier question around volatility, so it's the intermingling and the fact that all these stress and all these risks are intertwined that is concerning me the most. First, we have to understand, what the current situation is likely to lead to. I don't think that we are going to be in an environment where, there is any form of balanced budget going forward. Yes, if we hit the debt ceiling itself, by definition, essentially, outlays have to equal revenues. But I would imagine that the stress would be so great that there would be a very rapid policy reaction to avoid what would essentially be a self-inflicted recession by the largest economy in the world. That would be, in my sense, the most likely outcome. What's likely to happen going forward, though, as I mentioned, is this idea that we will likely see Congress pass some form of budget that is more restrained in terms of future deficits. So essentially, it's not so much that that Congress would pass, a 10-year budget that would have a balanced debt or no deficit essentially over the next 10 years, but instead that it would cap the potential increase in the deficit and the debt going forward. Not so much that it would cap both of these. So in doing so, that has implications because it means less emissions less growth because it's restrictive in terms of growth momentum, but also less accumulation of debt, and then therefore less need to finance their treasuries in terms of financing the bonds that it emits. So that's the type of trade-off we're looking at. We're not really looking at a sudden, essentially, disappearance of the U.S. debt. The U.S. will likely forever have elevated debt, and it will likely, for the foreseeable future, continue to run a deficit, import more than in exports, although on the energy front, that has started to shift, especially with natural gas exports having surged in the last year. But that's the type of dynamic. I don't foresee a complete shift of the U.S. economy away from a deficit nation.
I feel like we need to hit on the ECB a bit, especially given what looks like a quickly decelerating Germany. What are your thoughts on monetary policy from Lagarde, and is the Fed factoring in at all where the ECB is at because of the cross currents of currency?
Well, I think the ECB is in a different situation and has been in a different situation because of the different nature of inflationary dynamics. Just to do a little bit of a flashback, U.S. inflation has always been essentially broad based, right? The acceleration in inflation wasn't just one segment of the economy seeing higher prices. It was, of course, sparked by the goods segment. We were seeing strains in supply chains around the world that was putting upward pressure on prices and costs that were being passed on to consumers. But it very rapidly broadened out to energy, food, services, housing. It's essentially inflation across all different segments of the US economy. The European picture was somewhat different, where the supply side, and in particular, goods and energy, were the largest drivers of the acceleration in inflation. But now that we're past this peak impetus in terms of energy price inflation and goods price inflation in Europe, what we've started to see is the unfortunate lagged effect that comes via wages and indexation of wages, because a number of economies in the Eurozone have the system of indexed wages, which is often based on prior inflation. And what that does is it essentially creates an environment where inflation permeates into the future via this indexation of wages. If you think about it from a basic standpoint, you have an environment where inflation, let's call it, was 10% to give you a round number in the prior year, then you're going to see wages being indexed at a relative level compared to that 10% going forward. What that means for business leaders and business executives is that they then have this lagged impact on their costs, on their labor costs, which they then have to either take the bite for or pass on or increase productivity. We can talk about productivity because I think that's one of the most important elements in this business cycle. But usually it's going to be either they take the hit in terms of their bottom lines or they actually pass them on to consumers. If they do the latter, then that creates an environment of more persistence, more sticky inflation. And that is unfortunately the situation that we're facing right now when it comes to Europe. So Lagarde is in this environment where it's seeing a notable slowdown in some of the more manufacturing intensive economies, Germany being the prime example. It used to be the strong engine of growth across Europe. It's now one of the laggards when it comes to economic activity. Service sector activity in Europe remains quite resilient still. We're still seeing some strong signs when it comes to the most recent indicators, the most recent PMI indicators, for instance, the purchasing managers indices. Those are diffusion indices that indicate strong momentum in the services sector. And so in this environment, the ECB has also been tightening monetary policy at a rapid clip. It's about 150 basis points behind the Fed when it comes to the level of the policy rate at 3.5%. But it has been proceeding with fairly aggressive rate hikes, did 50 basis points on a few occasions, now has gone back to a 25 basis point increment at its last meeting. But Lagarde was key in was really indicated or stressed that there was still more scope for further tightening of monetary policy going forward. So the ECB, whereas the Fed is on pause, granted a hawkish pause, but on pause, and the Bank of Canada as well, and the Bank of England may be as well, the ECB is still leaning towards tightening monetary policy, perhaps with a further, let's call it 50 basis points of rate hikes coming over the next couple of months. And that is really going to be reflective of this environment of a lagged pass-through of inflationary dynamics that will come via the wage channel.
That, though, of course, could keep our own inflation stickier, at least for a bit of time, right? So conceivably, the ECB keeps raising rates. That puts upward pressure on the euro. Dollar weakens. That's inflationary. It's like I joked about that before when if you remember, when I think it was November, when inflation print, CPI print, everyone was cheering it and the dollar collapsed. And I tongue-in-cheek said, well, the dollar just celebrated weaker inflation by being more inflationary, right, in terms of the drop back then. Presumably the Fed is going to be seeing that and mindful of interest rate differentials. It doesn't sound to me like you think that would cause them to adjust course, but that's got to be a consideration somewhat.
It is a consideration, but I think we have to be careful with the assumption that the dollar has a major inflationary effect in the current environment. You have to always remember that in the US, although we import a lot, we invoice about 80% roughly of our imports in dollars. What that means is that there is no strong FX effect when it comes to import prices. They're still there. But they're not as strong as generally believed. The other thing is that when it comes to inflationary dynamics, just focusing on those first, we have seen that import prices are actually deflating. So prices are falling when it comes to import prices. So that's a deflationary, a disinflationary influence on consumer prices in the US. I think the interesting question when it comes to the foreign exchange effects is whether the Fed pause actually influences the ECB. So essentially flipping your question around, is there an effect whereby the ECB looks at what's happening in terms of the Fed and decides it need not go as high because contrary to the Fed, the inflationary pass-through from the FX side in Europe is actually quite significant. So there could be this argument that given that the euro has strengthened vis-a-vis the dollar and that you've had the benefit of this disinflationary current over the past few months, and that the Fed is now on pause, there's less of that aspect of gaining relative, taking an advantage in terms of the relative interest spread, and therefore less of a need to tighten monetary policy further from an FX standpoint. I don't think that changes the dynamic in terms of what the ECB wants to do, but that would be essentially flipping the question to the ECB now that the Fed is likely at its terminal Fed funds.
Yeah, and it gets to be more intriguing if the market's expectations are right about the Fed cutting, and then good luck with the ECB trying to counter
exactly.
that. I had a couple months ago Louis Vincent Gov of GovCal, and his argument at the time was you're not going to have a recession because China is going to drive global growth, right? That would be sort of the real engine this time around. Any thoughts on how China and their monetary policy, their fiscal response with their own reopening is muddying things in terms of central bank action from the Fed and the ECB?
Yeah, I mean, it's very interesting to watch and observe how the Chinese economy has been evolving. I mean, we know it was the last big economy to really let go of its COVID policies, and it did a major, largely unexpected, by the way, U-turn when it came to the zero COVID policy, and that has led to a significant acceleration in economic activity. Now, the notable feature in China is that actually, when you look at inflationary dynamics, they are very weak. You're looking at PPI that is contracting. I don't have the exact figure, but I think it's down about 1% to 2% on a year-over-year basis. And consumer prices are in the 1% to 2% range on the upside, but still very moderate inflationary dynamics because you've had less of that consumer impetus, less of that fiscal stimulus when it came to economic activity. And the combination of the zero COVID policy, the property sector slump, and efforts by authorities to avoid excess leverage that really curbed economic activity. Not forget that last year, China was in a recession of its own, growing only 3% when it came to GDP growth. Now we've seen an acceleration in economic activity. We had growth at 4.5% in the first quarter. We're likely to see growth for the year closer to 5%, maybe slightly above 5%. We're seeing a bifurcated economy, which is important to remember when it comes to international flows and the international support that China can bring to the rest of the world. Because I'm digressing a little bit, but in prior cycles, the credit impulse in China has been countercyclical, right? In the financial crisis, even in the early days of the COVID crisis, you had this environment whereby there was a slowdown in global economic activity, but there was a very strong credit impulse that supported Chinese growth. And because Chinese growth was so import intensive, that generated positive spillovers for the rest of the region and the rest of the world. In today's environment, where a lot of the rebound in economic activity is service driven, it does not have zero spillovers for the rest of the world, but it means that the spillovers are very different in nature, and I think to a great degree smaller than they've been in the past. Travel and tourism is certainly a big part of China's exports, but it's certainly nowhere near comparable to the import size and the import pull when you're thinking about infrastructure spending, when you're thinking about real estate activity, when you're talking about manufacturing activity. That pull is not as strong relative to the headline GDP print. And that means that the spillovers for the rest of the region are much less significant. And we're coming out of an environment, to go back to your question, where the Bank of China was essentially easing monetary policy, reducing the reserve requirement ratio to try to stimulate its economy, but doing so with guard so as to avoid the prior excesses of the past, where leverage was really the main means of getting economic activity underway.
Yeah, no, super, super interesting. For those that are in the audience that want to track more of your work, Greg, how do they find you, and what resources do you recommend?
Yeah, well, there are a number of avenues. I mean, you can certainly follow me on Twitter at Greg Daco, but you can also follow me on LinkedIn. I produce a regular newsletter that I publish every month on the global macro developments and what they mean for businesses, for business executives, and for investors. And we have our EY macro page on the EY platform, where we post some of our research and some of our insights, which is also widely accessible to broad audiences.
That's a good place to wrap this Twitter space up. I've got 10 minutes until my next one, so I'm going to do a little prep work here. Everybody, please make sure you follow Gregory here on Twitter. Again, this will be an edited podcast, and hopefully I'll see you all shortly. Thank you, Greg.
Thank
Really
you. It
appreciate
was a
it.
pleasure. Thank you.